In this video, Iran blocks the Hormuz Strait the day after it was opened. Option prices remain at low levels, providing good opportunities to buy, and as usual, an analysis of the weekly option strategy. Hello friends, this is the Optionomics channel and your host Roman Besedursky. And today, as usual, we'll go over the opportunities to make money with Bitcoin options. We'll also look at what interesting things happened over the past week and what's planned for the next week. Let's, as usual, start with the previous trade. So last week I opened a wide strangle at 76, a call option, and as it turns out, a 65 put option. At one point on Tuesday, Bitcoin made a very strong upward move. And it turns out that Tuesday was the day. And at that moment, it reached the strike price that was needed. That is, I needed Bitcoin to go above 76. And since this happened quite early and suddenly, the options jumped up quite nicely at that moment. So it turns out that I decided to lock in a small portion of the options around this particular candle. In reality, I locked in a very small part because I was expecting the move to be more exciting. And what happened? What happened was that, accordingly, I had 368 contracts of the 65 put option, and it turns out 368 contracts of the 76 call. I split this trade into two parts. When I lock in profits, I break up the trade so it's clear where and at what price the profits were taken. So I ended up locking in 1/10 of the position at $1,000. In other words, I bought at $257 and closed at $1,000. And as a result, I was able to slightly reduce my risk. So it turns out that otherwise I would have had minus 1.5% because Bitcoin ended up closing below 76. So as a result, for the week, I ended up with minus 1,253, meaning that relative to the risk of 1.5%, I lost 125. And now, as it stands, we've basically been moving sideways for almost 3 months, and the profit chart has just kind of slid down like this. So at these levels, even though the strategy isn't bringing in profits yet, I still intend to keep working from buying volatility. Why? Because first of all, as I showed, there was news that Iran, the day after it opened the Hormuz, it closed it again. That is, I believe this news actually supports volatility rather than suggesting that the market will remain sideways and continue to stand still. Accordingly, aside from this news, today in the open interest in options, we can see that option traders most likely do not expect the market to go above 75 for Bitcoin, at least in the near future. And another interesting point, when Bitcoin reached the 75 level, I believe around 65,000 Bitcoins were transferred to the exchange. So essentially, those who bought in the 60 to 70 range have now decided to lock in their profits. So essentially, these are not long-term holders who are counting on some kind of growth to around 100 or a new bull trend, but rather those who want to take advantage of a short-term opportunity to make a profit. And another interesting thing, the fear and greed index has once again entered the greed zone. So essentially, if you look at the news, what's happening is there is still some kind of ongoing military action between the US and Iran, meaning they still can't reach an agreement. At the same time, greed for Bitcoin has already entered the green zone. So accordingly, we had extreme fear roughly from the beginning of February until it turns out the beginning of accordingly. So it turns out for us 0, 2 months there respectively. Yes, it turns out that somewhere until the beginning of February, until the beginning of March, there was fear. Then people were still cautious. And now accordingly, everyone is entering such an optimistic zone that in principle, they think that since Bitcoin hasn't fallen due to all this, then probably everything is fine. Maybe that really will be the case and Bitcoin will continue to rise to the 80 to 90 range, but for now I still believe that at the moment the background is more in favor of us pulling back from the upper boundary of the sideways channel and accordingly going below 70. So let's go through our classic scenario. Accordingly, the forecast, then the choice of an option strategy, and finally the selection of risk for the week. So if we look at the chart, this is the situation we have right now. This is the sideways channel whose upper boundary can be considered to be somewhere around 75. So you can see that on Friday, immediately after the options expiration, the market shot up above it. That is, it reached 78, and now it is testing it from above. We have a scenario where the market could bounce off these moving averages and continue further, upwards. And if we look, for example, at the weekly chart, I quite often rely on moving averages, and accordingly, I expect that if, say, the growth does continue, then this growth could be approximately, well, it turns out somewhere in the area of the moving averages. That is, I expect that we could bounce to this consolidation area, meaning somewhere around 90,000 for Bitcoin. I think that's quite possible. If next week this escalation that's happening now doesn't develop further, But if we don't break out of this sideways range and now drop back below 75, and accordingly, if some more aggressive news comes out, and as a result, if there is some escalation of military actions, then I believe we could sharply drop below that minimum, which was around 60,000. So based on this, it turns out that in the first scenario, if we go up, that would be, it turns out, the boundary somewhere approximately around 80 to 81. That is, I believe that if we bounce off this average and move upward, we could go somewhere to 85 to 86. But if accordingly some negative news comes out, then it turns out we will drop back below this boundary. And since, judging by the open interest, I see that the options traders could very well push the market below 70, then to the downside, accordingly, I think we could go just below around 70, maybe to 69. So basically, I expect that in principle next week, by the end of the week, the market could break out of this corridor. And based on this, I will build my position. There's more. Let's take a look at the open interest. Here's what I wanted to show regarding open interest. Take a look. First of all, open interest in Bitcoin has increased this week. So you can see that basically we had about 445,000 Bitcoins at the end of March. Right now we have about, an additional 50,000 Bitcoins in open interest. The question is, where did this appear? In other words, where did the options traders open their positions? If we look at the open interest on the Deribit exchange and see where the main concentrations of open interest are, we can observe the following. So basically, for Bitcoin, as of the end of April, we currently have $170 million in open interest. If we look at the absolute values, it's around 8 billion. And at the moment, what do I see? I see that we have a spike around 75. So if we see a big green spike like this after some movement, it indicates that with high probability, the options traders are aiming for the market to stay at this level basically until expiration. The expiration accordingly is on April 24th. So it's generally beneficial for the options traders if the market doesn't go above 75 until the end of next week. If we take a look, yes, that's exactly what we get. April 24th is the monthly expiration, and accordingly, I expect that by the monthly expiration, most likely Bitcoin will be below this mark, or to be more precise, with high probability below this level. And if we look at the upcoming expirations for May, for example, by the way, there's quite a bit of trading for May. 126 million has already accumulated. Here as well, look, there's a big spike at the 80 level. Let's keep looking. For it turns out, yes, by the way, you can see here there's a large open interest. It's a half-year expiration. So that's for June 26th. Here it's already higher. So it turns out it's at 90,000. Basically, the road is a bit open. But there's this spike at 80. So essentially, where do we have the cap for calls? 70, 80, and 90. For puts, by the way, it's also 70. But the biggest one is at 60. And if we look at the open interest globally, I see that most likely until the end of May, judging by the chart, I think that Bitcoin won't go higher than, well, at most 80 to 85. And if we go down, then accordingly, we'll have support at the 60 level. Yeah, by the way, you can see it here too. By the way, at the end of April, you see, interestingly, the 60 to 62 level is significant. So, and also note that according to the Vela website, option prices have dropped quite a lot. And if you don't count the last 2 days, you can see here there was a slight jump when that news about Iran came out. But overall, options still remain very cheap. And even, by the way, according to the Delta's chart, you can see that the bias toward calls has become much more pronounced now. That is literally just in mid-April, people were buying more puts. Now, little by little, calls are starting to regain their advantage. Although, in fact, it's still quite a way off before calls surpass puts. So overall, if we look at a larger scale, yes, you can see that the last time calls exceeded puts was last year in July, August. All the rest of the time, fear mostly prevailed and puts were bought more. So we've looked here, we've looked there. Now let's see what we have with options. It turns out that If we take the weekly data, here's what we get. The last week went to an extreme of 7%, so it's still less than 10%. So there was literally just 1 week that went a little over 10, and that accordingly was on March 2nd. All the other weeks, starting from the beginning of February, so it's already been 10 weeks without such a big move. If we look and, for example, set it to 11%, we can see that, as it turns out, the maximum hasn't reached 11% in 29 weeks. So which week are we on now? So far, it's 10 weeks without any movement. Basically, yes, if we take the longest sideways period, it turns out it was 29 weeks. So technically, in fact, Bitcoin could still stay flat for another 19 weeks. But honestly, I still think that given the current external environment, that's unlikely. That's what we have for the weekly data. So we take the data, copy it into the backtester. And now look at something interesting. For example, just for fun, we can look at the data starting from 2017 and see what the backtester shows. If we were to work with such a massive and comprehensive dataset, we would then paste all of that information into the system. And we see that if we take the data for the year 2017, when Bitcoin had very high volatility, in fact, buying any options was profitable. So for example, if we take the 73 put option, you can see that from 2017 to 2022, we would have been making money, and then it seems like we lost a little bit after that. But due to the fact that the current volatility of Bitcoin is actually much lower than it was back then, when Bitcoin was less liquid and not as widespread, the data from 2017 is not very relevant anymore. And that's why we'll use more recent data, meaning we'll exclude 2017 from our calculations. And since I would still like to see how Bitcoin behaves during bear cycles, I want to keep the COVID bear cycle. And accordingly, the bear cycle that happened in 2022 as well. So I'm including data starting from 2020. And now notice that for now, since I haven't recalculated yet, you can see that the options are quite high. That is, it suggests that it would be profitable to buy them. If I click recalculate, you'll see that the puts have dropped. The calls, meanwhile, have stayed about the same because in reality, the bull markets were quite strong. So in 2021 and then in the period from 2024 to about the end of 2025, there were also good opportunities, including for calls. And now let's select the options, since I still want to take a strangle. So accordingly, I'll start by selecting puts. And for example, let's look at, say, the 7-year-old puts. The drawdown is 31% and you could have earned 41. Well, basically, yes, that's fine, but not that interesting. I want to try to achieve a better ratio. Of profit to drawdown, let's say 71. Here it's already a bit better, that is, it's 1.5, so that's 26% accordingly, 239. Let's say 69 and 3,320. Well, that's a bit more than 1.5, but basically it's even a little better. So from 9, it's even more interesting. And since I expect that if, after all, everything really does go badly, then it could drop significantly. So I don't want to take the kit that's too close, because then we won't have such large wicks. If the market really crashes, for example, 68 here, that's it. It becomes less interesting. You see, so 68. It turns out that we could have made 26%, and accordingly, the maximum drawdown is 19%. So the ratio of profit to maximum drawdown has decreased. And it turns out that beyond 69%, there's really not much point. At 69%, we get just over 1.5%. At 70%, it's about 1.5%. So 69% is quite an optimal option. Let's take 69% and add it to the portfolio. And now let's choose the calls. So if we do go with the optimistic scenario, we need to look at some options to the upside. And you see, because when Bitcoin rises, it often grows much more vigorously, and this has happened more frequently. The calls that are higher relative to the waterline, where our options move into the loss zone. So accordingly, let's see what we have here. Well, for example, if we take some 76 options, call options, that is those that are deep in the money, yes, you can see that in the end they would have yielded there. 273% with a drawdown of 9. Of course, it's clear that there haven't been any real bear markets for Bitcoin in a long time, because the ratio, if you remember, is only 1.5, but here we can earn 273% with a maximum drawdown of 10%. So it turns out that here the ratio is almost 30 times. That is 273 to 9. I would like to reduce the maximum drawdown because if there's a losing streak, I don't want to lose too much. Let's say if we take not 76, but for example 79, notice at 76, the profit was 276, the drawdown was 9. Now it's 79. The drawdown dropped by half, that is 4.5 versus 9. But the profit fell by about 20%. So I think this is a profitable option because it turns out that potentially we can earn only 20% less while our potential risk drops by half. Let's keep looking. So 79. We've checked that. Is there any point in going further, say to 81? The drawdown dropped by another 25% or so. Profit dropped. So we had, accordingly, 228 became 164. Well, here the profit dropped quite significantly. So basically this is already in general quite far. So there's probably no point in going for 81. We can set it at 80. Yes. And notice how big the difference is. By the way, even here in the chart, you can see that 81 and 80 are quite different. So when moving from 80 to 81, we end up with unreasonable losses in terms of the ratios. That's why 80 looks more attractive. So here our maximum drawdown is 3.87, while the profit remains in principle quite reasonable. So we get 200,000 and 3.87, whereas here we had 229,000 and 4.40 respectively. So overall the drawdown dropped by about 25%. Wait, no, not by 25%. As it actually turns out in reality, it is only by a mere 0.5%. That works out to be about 12%. And unfortunately, our total profit dropped quite significantly, going down from 228 all the way to 192. So accordingly, that's about 10% out of 22. And another 8%, that's about a third. So that's accordingly about another 3%. Well, yes, it turns out to be roughly comparable. So accordingly, both dropped by about 13%, both the drawdown and the potential profit. So basically 79 and 80, well, more or less similar in terms of benefit, but 79 is a bit closer. So what options do we have? Or for example, if you were to buy a total of 79 units at the price of $69 each and spend, as it turns out, exactly $560 in total on that. Or for example, if you chose instead of 79, to simply decide to take 80 instead, and spend, it turns out, $430 on that. So 530, 430. In other words, with the same risk, the options that are a bit further out are a little cheaper. We can take about 1/5 less. Here, accordingly, we will take a closer look, but we will have a higher probability of profit. So I guess I'll leave it after all. 79. So I accidentally hit 69. No big deal. I'll add it now. It turns out to be a 79 call option, and 69 put option. Let's do a backtest. It turns out that after this shooting, you can see that there is a sideways movement here. Because the data is from 2020, of course, there was increased volatility and there was quite a strong rise on strangles. But back then, naturally, such option prices did not exist. So it's more relevant to look from 2021 onwards. And it turns out that if we get the movement I'm expecting, we can roughly estimate the ratio. Our costs are $814. If it moves, for example, to 65, then it turns out the ratio will be about 1 to 5. If we drop below this minimum, which was, say, 59, then accordingly the ratio will be about 1 to 15. If we go up, since we took a closer position, then with a move, for example, of 10%, that is to about 82, the ratio here will also be about 1 to 5. 82, yes, 800. Well, that's roughly $4,000 in profit here. If we go a bit higher, say 83 or 84, then the profit here will be about 6,000. And if we look at the distribution, you can see from the distribution that overall, if we go down more than 10%, that would mean dropping to 68 or lower. So that happened 8 plus 9 plus 4 plus 2 times. So at the very least, that's about 2021 or 23 times. 23 times out of 328. So that's roughly about 10 times. Not 10 times, it's about 7% of the total. And for growth, things were a bit better here. So what we get is this. For growth, it was 14 plus 7, 21 plus 2, 23 plus 1, 24. And accordingly, another 2, so that makes 26. So 26 out of 328 is roughly around 8%. And accordingly, it turns out that I plan to take this kind of position for the next week because I still expect that volatility might spike. Now let's figure out the position size. It turns out that with the current position, we have the following situation. The current risk is $800 since we've already moved to an increased risk of about 1.5%. So accordingly, with a deposit size of roughly $108,000, so 1.5 times the risk is about $1,500. That is, if we take approximately 3.5 different options, then here we get, no, 3.5 is too much. Here it comes out to 2,153. So we need to take a little less. Oh, it is most likely around 2.8 or something like that. Yes, a little less, 1,722. I want to lower it by 6 more. Yes, now this looks about right. So let's take 2.5 each. Up to $1,538, but overall, that's fine. So accordingly, from this position, 2.5 of the 20.79 call and 2.5 of the 20.60 call. Made a mistake again, 20.79 call and 20.60. I am planning to go next week. So if the market jumps up or drops again pretty quickly in the first few days, say Monday or Tuesday, then I plan to partially lock in the position and I'll write about it in my Telegram channel. If you want to subscribe, the link is below in the description. It turns out that the maximum we had, if we take these strikes, was 11 losing weeks. And it turns out that, of course, we have a long position. At the moment, it has a higher probability of working out. It turns out that to the upside, we only need to grow by about 7% to get above this level, while to the downside, we would need to fall by more than 10%. Well, that's actually what I want because growth usually happens more gradually, while declines tend to occur more quickly. So that's the situation with this position, friends, and I'll move on to next week. Thank you to everyone who watched the video until the end. I would appreciate it if you support me with a like, comment, or subscription. And accordingly, you can ask any questions about options in the comments to this video or in my Telegram channel. Also, let me remind you that this video is not an individual investment recommendation and is made for educational purposes only, and all trades you make are at your own risk. Friends, I'll see you in the next video on Sunday. This was Roman Besedovsky. Bye.